438. That's unfavorable. Original contribution margin variance, we got 4,215,625 is favorable. Contribution margin variance is 5,438 favorable. For budget average contribution is 7,970, and for the strawberry we got 13,883. The contribution margin volume variance, we at original we got 3,985, and the strawberry we got 6,831 and 429. The sales mix variance, we got 857 for the each variance for the each flavor, which is the original and strawberry. For the market variance, we got 3,985. For the market size variance, we got 20,738 and 265 65. So this is unfavorable. This is for the variant 1. The variance 2. The variance 2 at February, the budget amount at the original flavor, the sales price is 7,000 with the sales unit is 4,000. So original flavor we got 28 million. The strawberry flavor is sales budget amount is 7,000 with the unit is 6,000. So total we got 42 million. The total of strawberry and original flavor is 70 million with the variable expense is 90,000. The total is 180,000. The contribution margin for original flavor is 27,910,000, and the strawberry flavor is 41,910,000. The total of the each for the original and strawberry flavor is 99,820,000. For the actual amount, the original flavor we got the sales price is 7,878 with the unit is 4,000. The original flavor total is 31,511,250. For the strawberry flavor, we got the sales price is 7,628 with the unit price is 6,000, and the total of strawberry flavor is 55,766,875 rupiah, and the total for original flavor and strawberry flavor is 77,278,125 rupiah. For the variable expense, original and strawberry flavor is same, it's 90,000. The total is 180,000. The contribution for original flavor is 31,421,250, and the strawberry is 45,676,875, and the total for the original and strawberry flavor contribution margin is 77,098,125 rupiah. Now we go to the Joybean variance analysis at February. The sales price variance is 3,511,250. This is favorable. Sales for the strawberry is 3,766,875. For the price volume variance is we got 0. Strawberry we got 0. The original over sales variance is 3,511,250. For the strawberry is 3,788,66,875. The contribution margin variance at original flavor is 3,511,250. Contribution margin is 3,766,875. For the budget average contribution, we got 6,982. For the strawberry, we got 11,637. The contribution, we got 0 for each flavor. The sales mix variance, we got 0. The market variance, we got 0. And market variance, we got 0. Now we go to the overall PM. The overall PM, the production measurement January. The unit produced we got at January is 10,000, February 10,000. Stocking filling, the driver is 10, blending 8, strength 6, mixing and seasoning 5, packaging 7, inspecting 5. For February is 10, blending 6, strength 3, mixing and seasoning 2, packaging 7, and inspecting 0. For the partial operational production ratio, here the total and calculation we got at January. This unit products we devise to for each driver. The price we got from the cost info. Then we times with the for the PQ, AQ, and change. For the example is stocking filling. We got from 10,000 divide with the January partial operation 1,000. Then price January is 5,000. So we got this total, and here too for the AQ we just times for the this to this. From February production measurement January is 10, and the price February is 2,500. We got 25,000, and change just less from the PQ less AQ we got 25 until the total. Now we got the price recovery. The revenue at January we got 38,937.5. At February we got 77,278,125, and the cost we got 58,987 and 500. At February we got 81,822,500, and then we got a profit. At January is loss. In the February we got gain. For the price recovery is 35,870,187.5. This amount show the total we could lose if we don't do something in front improvement. So this is OHA, this overhead. the activity. With activity, the activity driver. This is the total driver period. This period 1. This is for the period 1, and this for the period 2. This is the fixed cost. And this variable cost period 1. This variable cost period 2. Total cost period 1 and total cost period 2. You can see this at cost info. Then go to the next is how we make the soybean. You can see this for the period 1. Then you can see this for the period 2. Okay, now we go to the inventory management. With the information is order cost is 8,000, holding cost is 16,000 per unit, and demand we got 4,200. Egg quantity we got 5,000. The AQ we got 64.80 something. Then total ordering cost we got 518 and 459, and the total holding cost is same with the ordering cost 518 and 459. The cost total is 1,036 and 919. This for the inventory management.
Bookkeeping is the recording of financial transactions, and it is a part of the process of accounting in business. The transactions include purchases, sales, receipt, and payments by an individual person or by a corporation. So now we will explain about transactions in journal. Journals are recorded in the General Journal Daybook. A journal is a formal and chronological record of financial transactions before their values are accounted for in general ledger as debit or credit. So here is the view of journal. For the transaction example, first, on 1 January 2019, Joybean Corporation invests cash in bank amount 500 million rupiah and machine 85,500,000 rupiah with useful life 10 years using straight line method for beginning equity. So we journal that on 1 January 2019, cash in bank and machine on debit and equity on credit. Next, on 1 January 2019, Joybean Corporation top up petty cash amount 5 million rupiah. So the journal is petty cash on debit and cash in bank on credit. Next, on 2 January 2019, Joybean Corporation purchased office supplies using petty cash amount 2 million rupiah. So we journal office supplies on debit and petty cash on credit. So we just need to journal the next transactions until the end of January 2019. Next is about adjustment. In accounting, adjusting entries are journal usually made at the end of an accounting period to allocate income and expenditure to the period in which they actually occurred. At the end of January, following is the data needed for adjustment. First, in 31 January 2019, office supplies on hand amount 1 million rupiah. So for the adjustment, we journal office supplies expense on debit and office supplies on credit amount 1 million rupiah. Next, insurance expense for January is 75,000 rupiah. So the journal is insurance expense on debit and prepaid insurance on credit amount 75,000 rupiah. Next, rent expense for January is 1 million rupiah. So we journal rent expense on debit and prepaid rent on credit amount 1 million rupiahs. So we just need to journal the next adjustment until the end of transactions. Worksheet is a tool used to help accountants complete the accounting cycles and prepare year-end reports like unadjusted trial balance, adjusting journal entries, adjusted trial balance, and financial statements. Here is the view of worksheet. First, we need account number and account name. We get it from sheet chart of account, like this. And next is the account opening balance. We didn't have any beginning balance because we just started the operation this month. Next, transaction journal. We get it from general journal on 31 January 2019. Then the next is balance. Balance is the difference between transaction journal debit and transaction journal credit. So we got the balance. Next is an adjusted trial balance. If the balance is positive, then it will be on debit side. Then if the balance is negative, it will be on credit side. Okay. Next is about adjustment. Adjustment, we get it from adjustment journal on 31 January 2019. The next is adjusted trial balance. The formula for debit, if the unadjusted trial balance on debit side, the formula is unadjusted trial balance debit plus adjustment debit minus unadjusted trial balance credit minus adjustment credit. Then we got the adjusted trial balance on debit side. Okay. Next is about financial performance. Financial performance is included from a revenue account until the other expense account, from sales to expense. Next is about financial position. Financial position is from asset account until the equity account, like this. Okay, and for the closing and post-closing trial balance, we get it from closing journal on 31 January 2019. The closing journal is a journal entry that temporarily balance the estimate balance, so that the company can know the profit or loss of the business for a period. So we must transfer all the revenue and expense at the end of a reporting period to an income summary account, which result in the net income or loss for the period. So the difference between income summary, we will close it to retained earning. As a result, the temporary account balance are reset to 0, so that they can be used again in the following accounting period, while the net income or loss for the period is accumulated in the retained earning. Next is financial statement. First, statement of financial performance. Statement of financial performance is summarize the revenues and expenses which incur during a specific period of the time. First, sales less cost of goods sold, then we get the gross profit. After that, deduct with all the operating expenses, then we get operating income or loss income. After that, deduct again with other expenses, then finally we get the net income or loss income. Next, statement of equity. Statement of equity portrays changes in the capital balance due a reporting period. First, because we just started the operating this month, we doesn't have any beginning balance. Then we add with additional paid in capital, and because we lost, then deduct with the additional paid in capital. And finally, we get the increase in owner capitals, which is same with owner's capital on 31 January 2019. Next, statement of financial position. Statement of financial position is another term for the balance sheet. It lists the asset, liabilities, and equity of an organization as of the reporting date. So, we add all the total asset, the current asset, plus the fixed asset or non-current asset. Then we get the total asset. After that, add the liabilities and equity. Then we get the balance same as the total asset. So now we will explain about quality control and environmental costs. In this cost, we get some categories, which the first is prevention costs. Prevention costs that explain about expenditure made now to reduce future outlays. The second is appraisal costs. Appraisal costs that explain about expenditure made to monitor how companies' activities affect the environment. The third is internal failure costs. Internal failure costs, which means expenditure made to correct environmental breakdowns discovered in appraisal effort. The last is external failure costs. External failure costs, which explain about expenditure incurred when the resolution or remediation efforts fall outside the control of a company's management. So first, we get two prevention costs: quality training and marketing research. Let's start with the long-range performance report. For quality training, we have 1 million rupiahs for actual and target 500,000, and the variance is actual less target, which is 500,000, and unfavorable because the actual is more than we had budgeted. Marketing research, actual 500,000 and target 400,000, and the variance is 100,000, unfavorable. For the appraisal cost, materials inspections, we have actual 600,000 and the target is 500,000, with variance 100,000, still unfavorable. Process acceptance, actual 500,000 with target 400,000 and the variance is 100,000, unfavorable. Next is internal failure cost. Re-inspection with actual 400,000, target 200,000, and the variance is 200,000, unfavorable. Downtime, actual cost is 200,000 with no target cost, with the variance is 200,000, unfavorable. Next is external failure cost. Customer complaints. Actual cost is 200,000, with the target is only 100,000, and the variance is 100,000, unfavorable. So we total the quality cost from prevention cost plus appraisal cost plus internal failure cost and plus external failure cost. And for the percentage of sales is the total quality cost divided with total revenue sold in period 1. Next is environmental cost report. For the formula is same as the long range performance report. So next is for the next period, February 2019. Here we still have SAM, prevention cost, appraisal cost, internal failure cost, and external failure cost. But this period, we increase the quality cost by 30% to completely erase the failure cost. And for the environmental cost report, we have found the way to prevent the pollution. So the internal failure cost and external failure cost will be 0.